Welcome back to our intermediate financial accounting class. We have been talking all about inventory over these last few segments. We've talked about why it's important, we've talked about how we can track it and measure it, how it can mess up net income if we get it wrong. We've talked about dollar value LIFO, regular LIFO, FIFO, weighted average, periodic, perpetual, and we've done a ton of different examples. All sorts of cool stuff. No journal entries, which was kind of a bummer, but at least we got to see a bunch of fun tables that allowed us to do all these important calculations. In the next couple of minutes, I want to wrap up this discussion with just some last conceptual issues that surround inventory. And the first thing I want to talk about is the ideas and concepts and key factors we want to talk about and think about as we're choosing what inventory method our company wants to use. Let's take a look. In reality, there's not much difference between average cost and FIFO. There just isn't. The big question is whether or not we want to use LIFO. And there's some important pros and cons. We talked about some of them already, but let's mention them again in the context of what makes LIFO better or worse than FIFO and weighted average. So first, let's talk about the pros. We get a much better measure of cost of goods sold when we use LIFO because we're using the most current purchases as part of cost of goods sold. So our cost of goods sold number matches really well with sales, what we're actually paying with what we're actually getting from our customers. Second, we get lower taxes with the LIFO system, and we talked earlier about how companies used to use LIFO for tax and FIFO or weighted average for GAAP, and the IRS said, no, you can't do that anymore. You have to use the same method. So companies switched to LIFO. Why? Because that higher cost of goods sold translates into a lower net profit. A lower profit gives them a lower tax rate, or at least a lower tax value. For most companies, they prefer this drop in their taxes. And because of the drop in taxes, we now have better cash flows when we're doing a LIFO system. Now, the cons are, number one, that we have reduced earnings, which was the whole point, right? That gives us lower taxes. But we do have to recognize the fact that when we report under GAAP, net income is lower. In addition, our inventory value is lower. So not only is our earnings per share number less, or our profit margin less, but our current ratio is going to be less because our inventory is being understated using all these old values. For most businesses too, it's an incorrect flow. We don't sell the newest stuff first, we sell the old stuff first so it doesn't go obsolete in most businesses. We did talk about a couple of instances where LIFO really does match what they do. But for most businesses, this is not the real flow of inventory. We're choosing LIFO, if we do choose it, for the tax benefit, not because it matches what we're really doing. And that can lead to liquidated layers, which mess up our earnings number or inflate it artificially. And it can lead to poor buying habits because I'm paying attention more to my LIFO sales and not keeping track of these layers and ending inventory. I'm too focused on the current benefits of reducing taxes and not on keeping track of inventory and how it's really flowing through my business, especially if I'm wanting to build layers so that I can liquidate layer. That really messes me up from a buying perspective. The important thing though, for most companies, even though this list of cons is longer than the pros, that tax benefit is so significant that for most companies those cons are outweighed by that one big pro. So LIFO is the most common method in the US. Now, just a quick note here. We talked back when we discussed the income statement about changes in principal, and this is one of the areas that really is treated like a change in principal if you switch from LIFO to FIFO or FIFO to LIFO or whatever. Switching inventory methods really does count as a change in principal. Even switching in and out of dollar value LIFO from normal LIFO would count as a change in principal, and you have to do a significant amount of work to show that in your financial statement. So just be aware that if you decide to flip back and forth, you have to have a good reason and convince the auditors and do a lot of work to make that change. We haven't talked a lot about IFRS in inventory, and that's because there really aren't a lot of differences. In fact, the only real significant difference is you cannot use LIFO under IFRS. You can still use FIFO or weighted average, but you cannot use LIFO. This is one of our key concepts, actually, is this one significant difference between US GAAP and IFRS. Why? Because LIFO is such a huge tax break for US companies that they're pushing against the switch to IFRS just to save this tax break. It's estimated that if we were to make all of the companies using LIFO switch, there would be a $10 billion tax consequence just for the change. And companies don't want to pay that. so they're fighting against it. So this is one of the major differences, not only between the two, but keeping us from merging any more closely. So again, key concept to understand that this is getting in the way. Last thing we want to talk about with inventory, and that is how do we track inventory and see if we're doing a good job or not. Well, inventory turnover is probably our best ratio for tracking our inventory and how well we're moving inventory through our system. You can see the equation down at the bottom. We take our cost of goods sold, divide by our average inventory, and bigger is better. The bigger the number, the faster we're churning through our inventory and getting it out the door and to our customers. We've talked about a lot of different things with inventory now, haven't we? We've talked about all sorts of conceptual issues, we've done all sorts of methods. Inventory really is a big deal, and there's a lot that goes into it. And now, as you're more comfortable with it, you'll be better able to both track it, analyze it, discuss it, etc. as an accounting professional, or as another business leader who just wants to be able to talk the talk and make the important decisions. With that said, we're wrapping up this discussion. When we start again, we'll be talking about property, plant, and equipment. More fun stuff to come. I'll see you then.